Kristen, you started this Inflationfighter ETF in the beginning of the year. We talked about it then in February. IWIN is the symbol, auspicious time to start it, right at the start of February. And it initially attracted a lot of inflows, but it's been quietly sinking in the last week. This is a mix of stocks and commodity-like instruments. What's in this, and why is it, too, starting to sink?
Yeah, so there's a variety of assets in here. When you look at top holdings, you'll see everything from gold futures to soybeans to land development companies to fertilizer and timber stocks. So it's really a kind of a mix of scarce assets either in the form of commodities or stocks that are in the commodity business. But with this market, correlations are kind of going to one based off all the sell-off conditions. Most of these assets are starting to trade downward given the increase in volatility. In addition, kind of before Friday, Bob, we saw many investors talking to us about maybe thinking that inflation had peaked or that it was still transitory, and they obviously got surprised on Friday. So kind of a new day here starting out the week with Friday's bad inflation numbers. So we'll see kind of what happens once we get out of this kind of macro risk off of it.
Yeah, gold is your largest, gold futures are your largest single holding there. How is gold faring as an inflation hedge? I mean, it's flat this year, so I guess you could say it's performing well against equities, but why is it not doing even better? I mean, the gold defenders, these guys, when I go to them, they always say, oh, well, this year the dollar's been strong, so that's a problem for gold. But is that the only reason? I mean, it seems pretty clear to me gold demand has declined in China and probably India, too. So, maybe it's not such a great inflation hedge when you have this kind of weird macro environment.
Yeah, I think one of the things working against gold this year is that interest rates are rising, so there's more income to be had. And remember, gold doesn't deliver any income. So when there's not much out there to sit in cash, gold can be an effective alternative. But with rates rising, high interest savings accounts are maybe now paying 50 to 75 basis points. It makes it maybe a little less attractive from a gold perspective. So I think that's one of the factors in this mix, this crazy mix of inflation and rising rates.
Yeah, Mike, this is the problem with a really broad market decline, which is what we're seeing. Everything goes down. You've got your inflation hedges go down. Christian's got farmland in here, Farmland Partners, Texas Pacific Land. They're down, too. So all these holdings drop. Bitcoin drops. Land holdings drop. Gold drops. So it's very difficult at this point to figure out what should be doing, what individuals should be doing at this point.
Yeah, it's a tough market, that's for certain. I mean, I think the saying holds true. Everything correlates to one in the down market. Though I would argue there are pockets of strategies that have been forgotten about that are doing quite well this year. Obviously, energy and broad-based commodities are doing fantastically. The world's kind of forgot about them in the last decade as we've been, in a non-inflationary market, a growth-propelled market. But the folks that manage to hold on to those allocations within their portfolios are being rewarded nicely for staying the course with some of those strategies. And you're also seeing some strategies such as managed futures do well in this volatile market. More of that trend following with the long, short, in the futures markets. A number of ETFs in that space are doing quite well. So a traditional kind of buy and hold alt portfolio is doing what it's supposed to have done this year. The problem is so many of these strategies are used tactically, and as we know, trying to time when these strategies are going to add benefit to your portfolio is extremely difficult.
Yeah, it's just about impossible. The old adage is it's time in the markets, not timing the markets. That's one of my favorite old lines back from the 1990s. Let me move on and talk a little bit, Christian, about some other inflation-fighting strategies. You have a dividend growth strategy, enhanced dividend ETF. It's got a lot of blue-chip dividend payers in it. Chevron's in it, United Health, Johnson & Johnson. But it also has a kicker, a tactical call writing strategy. Explain that.
Yeah, so the ticker is DIVO, D-I-V-O, and it's companies that are growing their earnings as well as growing their dividends. And then the manager of the portfolio has the ability to tactically write covered calls on these blue chip companies to produce additional income. So this is a 5-star ETF. It's ahead of the S&P by about 10% year to date, and is paying a distribution of nearly 5% that pays out on a monthly basis. So those kind of high quality names that have a built-in hedge, and that hedge is growing their earnings, allows those names to be a little bit more attractive in volatile markets like this. And certainly if we get into a crash scenario, having blue chip companies that are profitable and strong balance sheets, we think will be helpful as well. Yeah. So Depot's definitely been kind of a highlight for us at Amplify this year in terms of performance and assets under management growth.
Right. So if the S&P is down 20%, it's down, what, about 10% so far this year?
That's right. Yeah, I think coming into today, the S&P was down close to 18%, and we were down a little over 7%. So there's been some less kind of downside participation, if you will, from Devo than just owning the market.
And I'm rather surprised you can get 5% annualized return out of this. I mean, the top end oil companies are doing, what, 4% or so? How are you, and Johnson & Johnson isn't close to that. How are you getting 5%?
Yeah, so the dividend income of about 5%, about 2% comes from actual dividends from the stocks that are held by the ETF. An additional 2 to 3% has come from option writing or covered call premiums. So that's how you get to that 5%. The interesting thing about this ETF is as volatility in VIX increases, there'll be more option income that can be harvested. So historically, the strategy has had a 4 to 7% total yield, and that's again from dividends and option writing income. So, being at around 5% right now, we've been at the low end, but volatility hasn't been that high over the last 4 or 5 years. If we get into a higher volatility, we could get up to that 7% range.
But so what's the downside? Under what circumstances would it underperform just owning, say, the S&P 500?
Yeah, so in big growth markets where growth stocks are favored, where S&P 500 is market cap weighted and has a big exposure to technology, Devo doesn't. It's really a blend of growth and value with a bit of a tilt towards value. It looks a lot more like a Dow Jones Industrial Average type portfolio than an S&P portfolio. So when markets are up big, especially on tech, Devo underperforms. But in other cases where the market's more balanced or more volatile, this is definitely a more stable blue chip approach that we think can stand the test of time, and it has, as its 5-star rating suggests.
Mike, there are dozens of these enhanced dividend strategies out there. We've been covering them for many years, everywhere from just buying the highest priced dividend payers out there, which is a bit risky, to those that are consistently growing their dividends year over year, the so-called S&P aristocrats, as we say. And there are other sub-variants of this. How are they performing this year? And the spread is still pretty small. In this case of Devo, they've got a little kicker in there that's a major part of this, which is buying the covered call strategy. But most pure play dividend enhancers don't have that, do they?
Yeah, I think if you're looking at a long only equity strategy and you were to look across the dividend landscape year to date, one, they've been on fire from a flows perspective. You've seen a ton of money coming into these strategies. But if you think about it from a performance perspective, you've really seen an inverse of what we've seen historically or over the last decade in this space, and that is the high yielders are winning. So those strategies that are owning the deepest value, thinking of yield as a value screen, are performing the best. So kind of your traditional DVY type strategies or SDOG is doing really well. The funds that are focusing purely on yield and going after that are significantly outperforming those that have put in additional screens around quality or consistency of growth, like a VIG, for example, which has done very well in a growth environment, is not doing so well in this environment. On the option income or the derivative income side of the equation, where Devo would fall, I have to give a hat tip to Christian and team. Devo has done extremely well over the last 5 years relative to the S&P 500. Historically speaking, if you just look at a passive derivative income or buy right covered call type strategy, you give up a significant amount of performance during up markets because you keep getting called away, right? You're writing these covered calls, the market goes up, it gets called away, you lose that gap in performance. So if you take something that's a passive like a PVP or a QYLD, over the past 3 to 5 years, they've significantly lagged their benchmark, whether it be the S&P 500 or the NASDAQ 100. Devo is much more tactical. It's an active strategy. And if you look at it from a historical performance perspective, it's managed to deliver that extra income while maintaining a nice up-down capture ratio. And I'm just looking at it on my screen right now. It's kept up with the S&P 500 with much lower volatility over the past 5 years. And I think that really kind of lends to that idea of a tactical overlay versus a pure passive writing calls on a broad index. Over time, that type of strategy is going to lose ground significantly to the marketplace because we're in more up markets than we are down. So I think the tactical active overlay in this case makes a lot of sense if you're looking at the derivative income space.
That's a great point. A tactical overlay like we're seeing in Devo makes sense in when the market is like this, but it would have not necessarily done as well in the consistent up market. Christian, I just want to move on here. I want to ask you about the growth part of your portfolio. Amplify has a number of ETFs. You have a transformational data sharing ETF, Block BLOK. That was a big hit last year. You and I talked about it several times on air in 2021. It attracted a lot of inflows, but it's mostly equities focused on blockchain technology. So you've got MicroStrategy and CME Group in it. And it's tended to move with Bitcoin. So with Bitcoin in a new low today, so is Block. And just give us your thoughts on crypto here. Do you anticipate outflows from this fund, or how is it doing?
Yeah, so the fund is actually down for the year and seen a fair amount of outflows. It really is one of the highest correlated publicly traded ways to access kind of Bitcoin type returns. It's because many of the holdings are highly correlated, like a MicroStrategy, for example, to Bitcoin. But ultimately, Block's investment thesis is on blockchain technology, which is a broad-based technology of which one application is crypto. So we think there are other use cases, whether that's payment systems, third-party validation of transactions, data recording, et cetera. I think there's other applications besides crypto that are coming that will be game changers and good growth opportunities to invest in. So we're still bullish on the whole blockchain space. We understand how volatile it can be. We launched back in 2018 and saw Bitcoin go from 19,000 to about 4,000 in price before it rallied significantly. So we've been there with this fund before, and we've been able to come back and see strong performance. So I think volatility will continue, but we don't think over the next 3 to 5 years that these recent highs we're at are insurmountable. We think we can overcome those over time.